Welcome everyone to a new episode of the SME South Africa podcast. I'm your host, Marina Stein, also the editor at SME South Africa, leading the editorial team. Sticking to the current conversations that we've been having, we're putting the needs of entrepreneurs with regards to funding under the microscope. At the 2026 installment of the SME Funding Summit, we spoke to a lot of insightful guests. Today, we are joined in studio by Thabang Hleza, one of the speakers who joined us at the 2026 SME Funding Summit. He is the head of investments at the Old Mutual Masisizane Fund. During the summit, he presented on the topic of going beyond the check to provide SMEs with the support they need. Thank you for joining us today, Thabang.
No, thank you. Thank you for having me, Marina.
So, what I really liked about your presentation is how you highlighted that there's a need for not only placing capital into a weak system, but really building SMEs to be able to use that capital and really present a return on investment. Because on the lender side, with a lack of credible data, management routines, and compliance discipline, all the lender sees is risks. So you described one term there called the South African capital paradox. Can you dive a bit into what that is?
Yeah. No, thank you. Thank you very much. So currently, Richard says you've got about a 350 billion funding gap in the ecosystem. And really, that is a function not of no applications looking for funding, but really a function of there's enough investment-worthy opportunities, but not investment-ready. So there's a funding mismatch between what SMEs are looking for and what then funders are looking for, right? And a greater part of that gap is what then funding readiness, capacity building seeks to bridge.
Is that purely an absorptive capacity issue, or do you think that traditional financial institutions are structurally ill-equipped to underwrite these small businesses?
So it's certainly not absorptive capacity issue only, nor is it a financial structuring issue only. Right. The reality is we operate in an ecosystem where there's a structural mismatch between how SMEs grow and evolve and how funders, particularly the traditional financial institution, assess and manage risk. Right. Yes. One will argue that SMEs typically will not have reliable unaudited financial information. They don't have the required collateral. They don't have the equity contribution, and that typically then results in a information asymmetry. What do I mean by that? The SMEs understand the opportunity and the problem that they are solving, but then the funders cannot verify that information. But if we are to solely blame the SME for the funding gap, I think would be a very intellectually lazy argument, right? Because lenders typically, they look to fund businesses that have a strong collateral, historical performance, and predictable cash flows. Quite often, most SMEs have none of that, right? You've got a founder dependency, you've got limited and very light asset base, limited equity contribution to no contribution. So the traditional lens within which financiers look at SMEs, look at opportunities, SMEs have none of that, which then says we need to view SMEs and our assessment very differently, right? And in my view, I think there's a world that exists which a hybrid model can then be seen to assess SMEs opportunity, which one looks at not just capital, but capital, business support, access to market, and look at not necessarily the traditional credit scoring methodologies, but other alternative data underwriting methods, right? And that's what then will get us into a much better position. And over time, we should be able to reduce that funding gap.
This hybrid model that ties into the analogy you used of the F1 car.
And certainly, right? Because financiers do not fund businesses; they finance manage risk, right? And most businesses at the early stage, because in the absence of this info, N, the risk is quite heightened, and that's why then when you provide business support and capacity building, what then does for SMEs, it builds capacity, it builds systems, it builds processes, it enhances governance, and which then gives lenders and other financiers incredible and reliable data to make decisions. And if that happens, then the underwriting decisions are far better than when you do not have that verifiable data, which then immediately then reduces the risk that you are dealing with. Yeah.
So I did just mention that ties to me. For me, it ties into the analogy you used at the summit from the F1 car. For our audience who wasn't there, do you mind diving into that again and just explaining how that connects with this underwriting decision?
Yeah, and I think you touch on the Formula One analogy, right? One of the things which is really important, it's important that you're scaling capital. As you raise the capital, it lands in a business that has the capacity, system, and processes to absorb that capital. Because if that is not the case, you are really then putting a Formula One engine into a cardboard, right? That the business that was able to manually manage itself now has suddenly grown 10 times. And those manual systems are no longer able to do that. What then often does, you start to see operational leaks in the business, whether it's missed invoices, reconciliation suddenly not done, inventory not captured, and those do not stay small. They compound over time and suddenly manifest in loan default. Yeah.
I think that really dives into the key of what a lot of businesses experience. It's not the one thing you didn't do on that one day. It's the compounding over time that leads you to a situation that's almost out of control.
Exactly, right? Because quite often I've got one customer that I'm dealing with, then I'm able to manage all of that within my spreadsheets. But all of a sudden, I've got 10 or 15 more customers. Then it means then I've got need much better systems, much better control to manage my customer base and also to manage my cash flows. And if you go and raise capital without building that foundation, what then was to be a moment of success for a business can suddenly become that moment of failure.
What advice do you have for business owners to identify that areas that they need to build out a little more before they can continue?
I think it's quite often the businesses by very nature are founder-led, there's key man dependencies, and. But as the businesses then grow, what is important then is to understand who do I need to bring into this business to do what, right? Because that is critical. But also to understand what systems, processes, governances that I need to bring in place for me to be able to operate at the second level. So that is critical. But what often happens is you are still operating at the same lens that you had when you were a one or two man business, whereas you're suddenly servicing 10 more customers than what you were servicing initially. But it's also important to say, when do I need to bring in advisory support into my business, right? And this is where then the different pillars of business support comes in, which is key to say, I am here, I need to go there, and what support do I require that helps me then move from one place to the other? Yeah.
You mentioned the pillars of business support. Which pillars of business support do you notice businesses needing the most, and how do they manage bringing that in while balancing the time and the cost involved to execute?
So I touched on four pillars around business support, which really helps drive growth and de-risk businesses, right? One is really around technical assistance. And I made mention that businesses don't fail because of a lack of demand, but they fail because of the lack of capacity to hold to hold that growth, and that's really what quite often topples businesses, which then links back to my earlier point around the Formula One analogy, that what you want before then you start seeing this massive growth, that you build a necessary system that enables you to report timelessly, report accurately, have management information system, your governance is strong, right? The second part is really around strategy and advisory support. Again, to my earlier point, that as this business transition from a million rand business to a 50 rand to a 50 million rand business, what support do I require? Because then it says what strategic and advisory support that helps the founding team to suddenly then not depend on instinct to run this business, but to lean more on data and insight. So the other part that I touched on was access to market. And in my view, access to market is far more important than access to funding. And then finally is the turnaround and restructuring, because there's a world where businesses does not necessarily need to raise more debt, but it requires structuring and stabilization. And to your point around cost and timing, I think cost and time and support both are limited resources. So what is then critical is then to say business support in its very nature needs to be very targeted and diagnostic led. And that's primarily how our funding readiness program, which we're launching in August, is based on. That let us understand the challenges that you face as a business. How do we design a targeted diagnostic led growth plan to address those challenges, right? But the other part is also then saying, how do you prioritize the pain points that will drive significant growth in the business? And that's how you manage the cost and the time effect.
Okay, and that differs from business to business.
And it certainly differs from business to business, right? That what you do for a startup business to a business looking for growth capital, the support that is required is very different, right? If you're to provide very sophisticated intervention to an early stage business, it's not going to learn because the business is way too early to absorb that. But if you're to again to provide business support to a very mature business, it's not going to learn because that business has now institutionalized, right? Which then says the midpoint is in that growth capital and a scale-up space.
These conversations point to the importance that businesses need support beyond funding. Let us know in the comments on whichever platform you're listening to this podcast, what kind of business support beyond funding your business is looking for. Remember to follow and subscribe to this podcast wherever you're listening to it. And remember to click the notification bell to be reminded of new episodes. So Thabang, many investors view support as a social add-on. Yet you also argued that this is a portfolio quality lever. First of all, can you explain what the term portfolio quality lever really means, and then what specific metrics points to this or signals that it's not just a social investment but really something that's vital?
Yeah, and thank you for that, Marina. I think what is really, really important, and one of the fatal flaws in the ecosystem, is that business support has almost been synonymous to mentorship and training sessions, right? And nothing could be further from the truth. Because what business support really does, so if you look at what investment committee members are looking at, is really saying, if we're to deploy business support into these businesses, what are some of the critical changes that we want to see that business support is working? And in our experience, it says once business support is deployed, I spoke about one, information asymmetry, right? It helps reduces that, because then the quality of reporting, suddenly the business is able to provide management accounts in time, is able to provide forecast and accurate information in that. The governance structure is strengthened, right? But also the management team is able to articulate the variance and addresses the issues in the business, which is really, really critical. The second part, I indicated that businesses are typically founder-led, especially at the early stage of that businesses. And by extension, then you've got key man dependencies, which also then extend to execution risk at some point. What you then want to see after you've deployed business support is that the system, controls, and processes that you have put in place, they are able then to hold even if this founder is not in the business. Because what that says to me as an IC member, it says you've then been able to address key man dependency and execution risk on the back of your business support, which then says, to your point around portfolio quality lever, when I look at then the key portfolio metrics, are they then moving in the positive direction? Am I seeing a revenue growth in this business? Am I seeing businesses from a portfolio level that tends to survive much longer, even beyond our investment period, right? Which is really critical, because what we do as a fund says we want to fund businesses and create a lasting and sustainable impact. And you're only able to test that after the businesses has typically exited your investment period.
So the portfolio quality lever is really looking at the business as a whole.
Exactly.
Okay.
Yeah.
Okay.
So maybe to build on that, it says, this is the business that I've invested in. When I came into these businesses, this is where key challenge that this business was facing. One, business had key man dependencies during my investment period, and then the back of support that I've brought into these businesses. Have I been able then to address these key man dependencies? Have I built meaningful and sustainable succession plan in this business? Have I brought in a capable management team that is able to operate independently of the founder, right? But also, am I able then to see a positive movement in the underlying metrics that all funders want to see when they are then assessing the health of that business?
Absolutely. So, as I just also mentioned, many investors view support as this social add-on. Do you think that a lot of people only see that the type of business support comes from, you mentioned mentoring and so on, but only from CSI initiatives, or should there be a better effort in providing businesses with additional support that's not just limited to CSI?
Yeah, and I think CSI has its place. And that's why I was saying earlier, I think one of the mistake we've done in the ecosystem is really then to see business support and limit it only to mentorship and coaching session, and not see the financial impact that it has on the business, because there's a real financial implication of business support in putting in business support into a business. So that is really important, and that's why I ought to be clear that in putting in business support, what are the levers that I want to see, right? What levers am I trying to pull, and what direction and growth I want to see in this business on the back of this business support. But more importantly, business support should not be a blanket approach. And this is why you hear SMEs often complaining that we are overtrained, overcoached, and is precisely because of that blanket approach. But if we're saying, Marina, this is your business's post our diagnostic, these are the challenges that your business is facing. And this is the customized growth plan and the roadmap that we are going to go through in addressing the gaps that your business is facing. It's very different to saying, our readiness program says you need to go through 15 classes. Whether you're a CA or not, you need to do financial accounting 101. And that's where the problem is.
Yes.
Yeah.
So you just mentioned your funding readiness program again.
Yeah.
How will this help business owners really diagnose where their shortcomings are and where their focus should be?
Yeah. So our funding readiness program really assesses businesses across five key domains, right? One is financials, market readiness, legal, compliance, and technology, right? Which really says practically the business will come in, will go through a diagnostic process as is. This is your business today. We go through the diagnostic process against these five key domains and saying, where are the gaps in these businesses that inhibits you from raising capital? Because ultimately, our was to say, how do we assist businesses to raise capital and manage that capital sustainably, right? Once we've done then the baseline assessment, then we're able to put together a growth plan with the SMEs and saying, these are the challenges and these are the processes that we'll go through to address these challenges. Some of it will be coaching sessions, some of it will be workshops, some of it will be personal mastery, and that's the process that we'll go through. That at the end of the process, that we're able to say, you've able to address all of these gaps that were identified at entry, and we're able then to provide funding on the other side, which partly what makes our program very different. One is a stage cohort program, but secondly is a diagnostic-led program, which says, this is your business, these are the challenges your business is facing, and we go through the program to address specifically your challenge. What those challenges are addressed, then we make you available to investment committees for funding.
I like that because I think we're well aware that no business is the same as the next. Even if you have two businesses that look identical in theory, maybe both women-led businesses in the same industry with the same amount of employees, they're not facing the same challenges.
Exactly. And that's why then our approach says, let us look at your businesses, let us address the pain points that your business is facing. Instead of saying, come in, go through this 8 weeks program, and you're going to do exactly the same that the other business is going to go through. Whereas the pain points that your business is facing versus mine might be very different. You might have the customer, but not have the processes and systems to manage the business. Whereas the other businesses might have the process and all of that in place, but need access to markets. And that's why then the diagnostic-led approach is critical.
Thabang, so being an experienced investment professional, you bring a lot of insight with you, especially from the Old Mutual Masisizane Fund side. Why do funders, institutions like Old Mutual's Masisizane Fund need to move away from being a capital provider to focusing on being a capacity builder?
Yeah. So we've been around as a fund for 19 years, paid some school fees, and learned a lot in the process. And what has been true for us is capital does not solve the problems that most businesses are facing, right? It's not the silver bullet that people think it is. But capital amplifies, if there are opportunities, it amplifies the opportunities, or then it amplifies the challenge that the business is facing. So that's why for us it was critical throwing this 19-year lessons that not only do we provide capital, but we provide then the business support that enables the business to have the necessary capacity, system, processes for the capital to lend. Because if you're able to put the capital in a business that has the capacity, the systems and processes, you are then able to multiply this capital and the growth effect. If you do it vice versa, you run the risk then of crippling the business.
Yes. So, have you any success stories that you can maybe share with us where you've supported one business in that way and the impact it has had on how it's run?
Yeah, so we've got a number of those businesses. We've got exposures in agribusinesses. So we've got some business that we've been able to support in the agri space, able to access more markets. We've been able to support businesses in the retail service station space, able to support equally businesses in the manufacturing space. Because I think the key bit in our experience that funding is the easy bit. Right. And that's why you've got a number of funders in the ecosystem that are able to provide capital, but yet the approval rates remain very low, right? I think research says you've got approval rate are sitting between 10 and 13%. If you're generous, you're going to say they're about 20%, right? Which then says there's enough funding in the ecosystem, but you don't have the necessary opportunities for this funding to respond to, which then in our case, that's why the business support becomes critical because it helps to bridge that gap.
I'm finding it very interesting that you say funding is the easy part. Because I think from the entrepreneur's side, it doesn't feel like funding is the easy side. But now understanding, hopefully after our audience watches this episode, understanding that if you get all of the other compounding issues fixed, get them in place like they should be, then funding is the easy part.
Exactly.
Getting approved is then the easy part.
Exactly, because most funders really says they'll go through a process of saying, one, let us assess these businesses from a compliance and a legal perspective. Does this business fit our funding mandate? Is it compliance with all the necessary regulations, right? If that ticks, then it says, does this business have the necessary capability and a capacity from a management team to execute this strategy? And that's where quite often you also find challenges over and above the legal and compliance bit. But the other part says, can this business really service our debt? Right? If it's debt that you are raising, are you able to see it before a funder and be able to articulate why you need the funding, what you are going to use the funding for, and how are you going to then service that funding, which is then critical. Because if you're able to take the funder through that journey, right, then you're able to say, okay, I think this business is ready for funding, of course, over and above the other things that I've mentioned.
Awesome. So what is the key takeaway that you feel entrepreneurs should have by now, by the end of this conversation?
I think raising funding is great, right? But before you start raising funding, a couple of things needs to be in place. Make sure that in-house you've got the necessary processes, systems, and control in place to manage the funding. And they don't need to be sophisticated process. They can be manual processes depending at the stage where the business is at. That is critical. And make sure that you augment your processes as the businesses then grows. 1, 2, quite often SMEs start raising funding much later in their process, almost raising funding in a panic, which I think is a problem. So take time before you need the funding to scan the market and understand the number of funders with a mandate that respond to your business, right? Engage them before you need the funding. Masisizane, head Thabang, say 1, 2, 3, here's my business. There seems to be an alignment with your mandate. What will need to be true for me to raise funding with you in 3 years' time? or in 6 months, right? That helps us then walk the journey together. That by the time you say, I need funding, it's no more a question of, I'm raising funding today for an opportunity that was there yesterday, which I think is really critical.
It's not just jumping on your phone or your PC and going how to get funding.
Because the best time to raise funding, I often say, is when you don't need it. Because then you are able to negotiate better terms with a number of financiers in the market. But if you are then pressed for time, here's an opportunity, I need to respond to this PO, any term sheet that comes quicker, we are going to take that because I might miss this opportunity. Whereas if I had started engaging the number of funders that meets my mandate much timelessly, when that opportunity lands, then you're able to say, Thabang, remember we had this conversation, that opportunity has landed. How do we make sure that we respond to that accordingly?
That's wonderful insights, especially like you said, it's like business owners are frantically trying to get a hold of funding because it's now suddenly time. There's now something happening.
Exactly.
But then removing that pressure of urgency, you're able to think clearer. You can make decisions calmer. You can really assess which offers are available to you and what the cost, financial and otherwise, is going to be, and if it's worth taking on that debt.
Raising capital by very nature takes a lot of time. So if you are a two-man team, you're going to lose a lot of time knocking on wrong doors, right? If you don't understand who are the funders that meets my mandate, that meets what I am looking for. Whereas if you take that time much earlier before you actually need the funding from the 50 funders that respond to your mandate, you are able then to cut that down. That I'm raising a 50 million facility, their funding limit is up to 20 million, right? Let me then take those out immediately. These are the funders then that I need to engage. So you've already cut your coffee chats and your sessions into 3 versus the 50 that you will have engaged with, which then helps turn around your funding process much quicker.
I believe that's why it's so important to attend events such as the SME Funding Summit, because then when you're not necessarily in the market, you can start to get to know who's available out there, who's the right person for your business, what type of funding is it that you need.
Exactly, right? And I think you touched on an important point. Who's there and what type of funding do I need, right? Because then I am in these conferences and the summits, you're able then to say, okay, I'm looking for asset finance. These are the asset finance players over and above the other players. And over and above just the funding, this is the support that they provide. Given where my business is at, I need more than just the funding. I require the support as well, right? Which then reduces the engagements that you ought to have. Whereas if you are not open to these network sessions, attending summits and having these engagements, then you are going to engage a whole lot of people that don't necessarily meet your requirements.
I love that you added there, not only finding out who there is, but the support they offer.
Yeah.
The person out there providing support that meets your needs.
Exactly, right? Because as I said, if your business is at an early stage, there is some support that is required, right? So it's important then to say, who are the funders that not only just give me the check, but also then hold my hand and walk the journey with me. Yeah.
I think that's perfectly summed up by the title of the presentation you gave at the 2026 SME Funding Summit. Beyond the check.
Right. And I think to my earlier point that raising capital, not necessarily raising capital, but money is the easy part. And I say so because there's enough capital available in the system. Right, we're probably got one of the most matured financial markets in the continent. We've got enough funding mandates in the ecosystem. So by extension, then there's enough capital flowing to address the challenges that SMEs are facing. But then why then do we still continue to have this massive funding gap? And this is where this readiness and the capacity building becomes key.
Thank you so much for joining us today, Thabang. This was, as usual, always insightful and I believe useful to our audience walking away today. So thank you so much.
No, thank you. Thank you so much for having us. Thoroughly enjoyed it.
If you enjoyed the insights in this episode, remember to follow us wherever you watch your podcast. You can also follow us on social media, like our podcast, please rate us, and then we will see you in the next episode. Remember to share it with a friend or somebody who you feel might also find these conversations valuable. Goodbye.
Thank you.
Thank you.